Let's just dive in. Again, my name is Tony Kappert. We've got Niklas James here, who I'll let him introduce himself in a second. But today we're going to be talking about what to look for when acquiring an HVAC business. And Niklas, I should ask you, I say HVAC all the time, but I realize, is it HVAC or HVAC? What do you think most sellers prefer?
I think it goes by HVAC in the industry. When you talk to finance guy, they'll often say HVAC R, and they'll add the refrigeration component at the end. Okay. But that's really a separate industry.
All right. So HVAC, we'll go with HVAC then. Yes. So that's what we're going to talk about. We're going to dig into all the nuts and bolts, and we're really fortunate in that Niklas, he's been living and breathing this industry for a few years now. So again, I'll let him introduce himself in a second, but just briefly on me, I'm a software guy. So I really don't know the HVAC world well at all, but I do know the search fund world really well. I've been working with searchers now for a while, for over a year, doing many self-funded deals. And I love meeting people who are, looking to acquire and operate good businesses. So yeah, I've sort of left the software world temporarily and digging into self-funded search and looking to meet good searchers. And as part of my process, frankly, I'm trying to get smart on lots of industries, including HVAC, and hence why I put this webinar together. But Niklas, why don't you give a quick minute bio on yourself, and then we'll dig in.
Yes, thank you, Tony, and thank you for having me here today. I really appreciate the opportunity, and
yeah, of course.
I think highly of your initiative here to have this webinar series. First of all, you'll all have hear that I have an accent. I am originally from Norway, so I grew up there, went to college in London, and started my career at Bain & Company. At Bain, I did a mix of oil and gas consulting mostly, and then private equity due diligence group. Those were kind of the two main areas that I focused on while at Bain. After Bain, I had a quick stint in venture capital before I did my MBA at HBS. The photo on your slide is actually from HBS, which is now 10 years ago, which I just, I'm glad I kind of look similar still, so that's great.
Looks so bright-eyed and bushy-tailed in that photo. Nice.
Might be time to get a new one, I guess. But okay, anyway, after HBS, I didn't yet have a green card. I was very inspired by the search fund model while I was at HBS, but since I didn't have permanent residency, I took a job in the oil and gas industry in Houston. I'm from an oil and gas town in Norway. I'd done quite a bit of oil and gas through Bain, and at the time fracking was booming. So I moved down to Houston in 2013 and worked for Schlumberger as an operator in the field there, but mostly on consulting large oil companies on various strategy projects. So, and then after about 2 years at Schlumberger, I decided to leave, and I was very inspired by the search fund model still. A couple of my friends from HBS had at that point acquired businesses, so that looked really amazing. So in 2015, I started what is today Citis Group. I initially started as a self-funded searcher, but have since evolved into being more of an independent sponsor. Those two models are pretty similar to each other, but with the notable difference of, as a sponsor, you're looking potentially for a portfolio of deals and you don't do day-to-day. Whereas a searcher, you're looking for one deal that you're doing day to day.
Sure.
So since 2015, I've been involved in a good handful of deals, 3 as a general partner, 3 or 4 as a limited partner, and a couple of deals that I got under LOI, but I just couldn't really figure them out. So I sold them to private equity firms who subsequently bought them. So that's what I've been up to. Last year, we did a majority recap of an HVAC company that I've been working with for a couple of years prior to that as well. And that's what we're going to talk about today. And that's been a really fun journey. We're in the process of hopefully closing another 2 add-on acquisitions this summer. And just been having a lot of fun in the HVAC industry and the home services space in general. And feel this is a niche or area that I want to dig into more going forward as an independent sponsor.
That's great, man. Again, I appreciate you hopping in doing this webinar with us today. I think what I love about your background is not only, we're obviously going to dig into HVAC and talk about the industry, but you've been at this for a while and you've done many deals, and in both deals you've invested in, deals you've done yourself. And so I think as we're talking about, the specifics of the industry, I think you've got great insight, but also insight maybe about the process in general, like how to assess a good deal. So anyway, I think it will be a really good conversation. But just to kind of speed things along here, just a brief reminder, this is a webinar series. Niklas is number 2. We're digging into HVAC. We did light manufacturing with Sam a couple weeks ago, and we've got a bunch of other really good webinars slotted for the next couple of months. So if you're interested, shoot an email to webinars@bluemaple.co, and it'll make sure you get invited to all the future ones. And lastly, this is what we're going to cover. You know, I shared this on our first webinar, and it's true now. I really get frustrated when I'm on a webinar and it's very, you know, high level, not digging into the weeds. It's like painting it with broad brushstrokes. And so what I would love to do today, and what Niklas is awesomely agreed to, is we're going to really dig into the nuts and bolts of the deals he's done, what he looks for, and get as specific as possible. So I don't want to bore you with any more preamble. Let's just dig right in. Niklas, you want to walk us through the quick deals you've done, some of the specifics, and I guess specifically where we're at today. Like, what do you feel like is going well and not so well?
Absolutely. So I should have added in my intro, I currently live in Dallas. It's a great market for HVAC. It's cold in the winters and it's warm in the summers. So your systems are pretty much always on. As far as how did I get into HVAC? So my wife, who had been at Bain for 10 years, she left in 2018 to join Lennox International there in Dallas. And she's now an executive there. She runs digital in the residential sector. So she runs their e-commerce and several other things within their digital realm. Her being there really opened my eyes to this industry. It's fragmented. It's pretty unsophisticated. It's not going away. So pretty low risk from that perspective. So I liked all these components, and of course being in Dallas, a good space to be in it. So that fall 2018, I started looking for a platform company because I quickly understood scale is important, and I'll revisit that a little bit later. But that fall, I got in touch with a company called KNS Heating and Air. I really got along very well with the founder, who's a few years older than me. At the time, it wasn't yet ripe for doing an acquisition of it. The revenue mix and the profitability and the books were just not right there. So in early 2019, after we'd been kind of talking for several months, I said, well, you know, why don't I come on board and work part-time here for a little bit? We can continue to build a relationship. I get to build a narrative around this particular deal since I'm going to be an insider, and I get to help you hopefully get a higher valuation for your company since we're going to improve it. So over the course of 2019, we worked together. We grew the business, we cleaned up a few things, and importantly, we acquired a company called Lex Air Conditioning in April 2019. And all of that by the end of 2019 put it in a really nice position where the revenue mix was better, the narrative was really strong in that there was growth, and we had done a successful add-on acquisition. So that's when we signed an LOI. I made sure, since at this point I tried to give him a really good market price, even though I was an insider and probably could have gotten away with cheaper. But I think I gave him a good valuation even at that stage. And then early 2020, we started fundraising for this deal. COVID happened in March, which slowed us down a little bit. We were about 80% done with the fundraising when COVID happened. And then the investors and we decided, let's just see what happens here now. And to our delight, the company continued to perform during COVID. Home services, in fact, went up. So that was all exciting. So we closed the deal, a majority recap in July 2020.
That's awesome, man. And congrats on pulling that off. To your point, it was probably not looking so bright in March, April, maybe a full of last year. But obviously things have been great, to your point, home services throughout COVID. Just before we talk about sort of the deals or what's going well and not so well, I think it's really interesting that you decided to go down the sort of minority position, sort of get in the weeds, get this business growing even much more rapidly than it had been, it sounds like, and then do the majority recap subsequently, like the next year. I haven't met a lot of searchers who've done this. And so was this being driven, like, were you just not necessarily super bullish or were nervous about buying the business outright from the start, or was the seller hesitant to sell? Like, what was driving that decision? And would you have done it all over again the same way, or would you have done it differently?
It was driven by financing. In late 2018, I was already putting feelers out with financing sources for this opportunity. At the time, it was 18 million in revenue, 1.2 million in EBITDA. And 2018 happened to be a pretty rainy year in Dallas, so the growth curve was pretty flat that year, if not even a
Oh,
little
I got it.
negative. So
So
all of
were
that
lenders hesitant
combined,
to, like, because it wasn't showing this sort of stability, there was the drop, they were
yeah,
hesitant to lend
it
against it?
was hard to get it financed. I couldn't get the terms I wanted. So that's when I went back to the seller and I said, I think we're both going to be better off if we give it another 6 to 12 months. So that, and by then we have built a really good relationship that we maintain, of course, to this day. And that's when we structured a consulting agreement that included some partnership position for me in a minority sense. And that's how I became an insider. That was a perfect narrative, of course, to play 1 year later when we went out fundraising for the majority recap. And in this case, the majority recap, we acquired 75% of the company last year. So the owners they still own 25% of the company. They got to cash out quite a bit, but they're very much a part of the team and going to participate in the upside. And I think this is a differentiator for us also that I can dip into a little bit later as well.
Sure. And I don't want to dwell too much on this point, but why do the majority recap versus an all-out purchase, right? On the one hand, right, this is a relatively small business, so had you bought out the owners, you could have had pretty high leverage through SBA debts off the table in this scenario if the owners are staying on board. So, yeah, why go down that route?
Well, first of all, is what the sellers wanted. Secondly, I think unlike self-funded searchers, they really want 100%. They want to take the CEO role, and they want the seller to exit. In this case, it was not like that at all. I very much relied on them staying involved, and I needed them to be incentivized for staying involved. So, we were discussing anything from 65% to 90%, and we landed at 75% majority recap. That just felt right. Now, and one thing I think is very important, and this goes probably for many industries, is there's an element of hubris for us searchers. We come out of really good educations, we have good professional backgrounds, but I guess I have realized that we're not always the best person, at least not right off the bat, to run any given business out there. And HVAC, like every other industry, requires experience and expertise that I'm still struggling to get up to speed on. That said, I have a very complementary skill set that is not HVAC technical, but strategic and around financing, that I think is adding a lot of value to the company going forward. So by me kind of being not the day-to-day manager now, but letting the founders continue to have that role, it's been great for continuity and stability. And it's also been a true value add that when I'm coming in, it's incremental to what was already there, and there's been no risk around them leaving.
That's great. Yeah, and I think we'll touch on this in the next slide when we're talking about what good versus great businesses look like. I think, as we were talking with Sam in the last webinar, he loves, in his mind, a great business is one where the owner is decently absent, because if he's buying it outright, there's a lot of low-hanging fruit to drive additional growth. And it sounds like in your model, in the independent sponsor model, you really want that engaged management team, because on the one hand, you're giving up maybe some of the low-hanging fruit because they've been decently engaged in terms of what you could improve. On the other hand, you can be much less in the weeds and then continue to run the show. And I think, to your point, a lot of us searchers, we maybe underappreciate the value of keeping the ownership on board.
I think those two situations are very similar. If there's an absentee owner situation, it means that there's already a competent management team in place. So in those cases, when you come in, you're again incremental value. So I think those are fine. It's very similar to my situation.
By the way, I should just pause, like a housekeeping thing briefly. I see a couple of folks have raised their hands. Just in the interest of keeping things moving along, I'm not going to unmute people, but if you have questions, please throw them in the chat, and I'll take them either as we're going through or at the end. So definitely want folks to be able to ask questions should they want to dig into anything. Anyway, Niklas, back to you. So in terms of what's going well and not going so well, you want to just briefly summarize?
Yes. So on the what's gone well, I think it's been really genius to keep the founder team around for two reasons. There are two ways we pursue growth. One is organically, and the other one is through M&A. And organically, obviously, they have a history of growing the company from zero. So they know how to grow it, and whatever we can do to expedite and accelerate that growth, that's great. But there can definitely be drivers of that. And then on the M&A side, there are a lot of shops out there right now, a lot of financial buyers for HVAC companies. As I'm sure you all know, it's a very hot market. And I think one differentiator that I'm seeing emerge for us is that when we go to business owners, we can very much say we are founder-led. And in some cases, our founders are connecting us to business owners that they know and they have in their network who are interested in potentially partnering up with us. So not only is it giving us a better story with business owners, but it's also giving us better access to business owners. So on the M&A side, that's been good.
Do you find, is that true even in are you looking at broker deals and that's true helping you stand out from the broker pool, or is that primarily using the proprietary search?
Both very much.
That makes sense.
And yeah, since we did the majority recap, we've hired a marketing team, we've hired a VP of sales, we've hired a HR person. We promoted one to be kind of head of our Cool Club, which is our maintenance program, just because this is something, when you're in HVAC, the operators don't necessarily value it as much as the finance and PE guys will in 5 years from now. So I think we've really bolstered the team. I think we also put together a fantastic board, some investors, but also some independent board members last year. And I think that's been adding a lot of value. As far as what's gone bad, it's a little early to say anything is going bad. We're pretty happy about where things are going, but it's a hard industry it's very competitive, right? So it's hard. The best players will get the best margins, but even then your margins are going to be, if you're service pure play, you're going to be 15-20%. That's like absolutely world class. You can occasionally see higher for smaller companies, but it's tough. And right now there's just so much going on with supply chain, with labor. So it's really hard to kind of keep everything in sync with what we're buying, what we're paying, and what we're selling, and the prices there. Another thing I will say that is kind of dawning on me is, when you buy a manufacturing company where you're manufacturing products, or you have a software company, you can grow really fast organically. This is possible in HVAC as well, but it carries a lot of risk, because to grow, you need to have more technicians, you need to have more vehicles, and you need to invest in marketing. And all of these three investments happen up front.
I've heard this feedback across business services. It's sort of like, it's the bottleneck is in the technicians and maybe in the gear, like the trucks or whatever else, to be able to service. And there's to do that effectively and to retain those people effectively is clearly a risk.
Yeah, so retention is one thing, but then you can run into a cold summer where even if you had planned a lot of growth and you had invested in marketing, you're not able to spend the money you want on Google Ads because nobody is searching for AC repair when it's 70 degrees outside. So as an example, here in Dallas, we've just had a very rainy and cold May. And this harms our demand in what should be one of the hotter months of the year. So if we had hired 10 more technicians this spring, we would have had a hard time utilizing all of them. And that would have been a cost problem and also a morale problem. So this is why you need to balance organic growth, where you only add a little bit every year that doesn't expose too much risk and capital. And I think this is why M&A is such a big component of growing in HVAC.
Yeah, and I again, clearly you guys are pursuing that route. And so I want to, part of me wants to dig more into the M&A world, but let's, in the interest of time, there's a couple of questions that have come in. So I want to bring those up, and then let's go to the good versus great. Just briefly, again, I don't want to spend too much time because we're talking about structure versus HVAC, but when you came in as a minority position, what was the percent you came in at? And so you said you recapped to 75, but what was the minority? And was that, again, who was driving that more? Do you think that's a strategy that a searcher could go out with, doing what you did, like going with the objective of getting to know the business and the seller well through minority position, or was that like a happy accident?
It was probably more on the happy accident side. We had built a good relationship, and I knew he was interested in selling, so it was a pretty short term that he was going to sell regardless. If he was, had not decided that's the route he was going to go down, then giving me a piece of the cake might not have made sense, right?
Sure.
But because he knew it was going to be within 1 or 2 years, he could kind of calculate out what that value would be. So I guess if you ever try to strike a consulting agreement like I did, it would be more fair to call it a profit sharing agreement than a minority position. But just because of the nature here, my profit or bonus came at the recapitalization.
And what, like, I guess, what percent of that did you do?
So it was dependent on growth. So I got, she can't remember now, but it was a nice little 6-digit amount that I got out of it, and it was based on growth, percentage growth in EBITDA above the threshold they had back in 2018.
But I'm gonna pressure on this again. But something, are we talking like 10%, 20%, 30%? Like, just to ballpark it, you don't have to get exact number. But just
it was probably. I generally can't remember. I think it was 10 or 20% of incremental EBITDA above this level, something like that.
Oh, got it. So it really was aligning you with growth. Is basically the
Yes.
point. And to your point, profit share versus just owning actual equity. And I guess relatedly, then that was just you initially. There were no outside investors. Correct. Potentially on the recap, there could have been outside investors. Is that the case?
For the recap, we definitely had investors on board. Yes.
Yeah. Okay. So I'm just scanning the questions. Let me let's just skip to the next slide. We haven't talked too much about the industry yet, and I do want to get into there. I think we covered a lot of the why, right? Like that your wife obviously had experience at Lennox, huge HVAC manufacturer, and we talked about, in Texas where it's sort of like perennially year round, there's going to be HVAC needs. But was there any? I mean, those are two good drivers in and of itself, right? This perennial need, and your wife clearly knew the space. But yeah, I wonder if you could speak a little bit to how you thought about choosing maybe this, going deep in this industry versus another. I think it's often a question that a lot of searchers ask themselves.
I guess I'd had some experiences in the software direction. I'd worked with one software company in one of my deals, and then I had done an oil and gas software deal that I had referenced onto someone else, and I had seen how they evolved. There was quite a bit of risk involved with software, so this seemed less risk and more tangible. You can hold it. I, for some reason, really like the B2C component of our business. It's just easy to understand and intuitive, so that lured me in a little bit, and also I like the team and working more in a blue collar environment for whatever reason that I really enjoy it on a day-to-day basis. So yeah, there were a number of factors, but more than anything, I saw it as an opportunity. I guess I saw some of these bigger roll-ups that were happening, and I understood the value of scale. And let me touch on that a little bit. The value of scale, that comes in many ways, but I would say it particularly impacts procurement and marketing. On procurement, when we compare our procurement to smaller players that have less than 5 million of revenue, we buy 20 to 40% cheaper than they do on the equipment. And equipment is 50% of our costs. So this is just a huge opportunity for us to either provide better pricing or to have higher profits than the smaller players.
That's interesting. Do you think, just as a total aside, do you think there's an opportunity for searchers, let's say they're not in a position to do a roll-up or a platform play right away, or to do a bigger deal? Can you get that sort of efficiency of scale and price power by partnering together? Let's say a couple searchers who bought recent small HVAC companies could actually buy together to get lower pricing. Think that's possible or reasonable?
Joining a cartel like that, I've never thought about it. Potentially, I mean, the manufacturers, they obviously want to keep their profits where they are as well. So, but scale, however you get there, it can help with procurement for sure. So there are different classes with these OEMs that you can qualify in, and then for us, we're in, I think, the best bracket. So whenever we look at M&A add-ons, this is a huge synergy that we get right off the bat. And for this reason, you're seeing multiples in the industry are going up also, or are pretty high, because you have strategic buyers who immediately cut the equipment cost quite a bit, and it helps them pay more. So yeah, I felt it was a good opportunity, and I like the risk reward profile of HVAC. So that's probably the number one factor. And then I had gotten in touch with this particular team, and I really liked them. They're all like late 30s. And I thought they were ambitious, smart, and had all the right components were in place. So yeah, I mean, I spent with the consulting and everything. It took me 2 years, from almost 2 years from I first met them to I closed the majority recap last summer. But I enjoyed the process, if not all the uncertainty in the process, and we had a good outcome in the end.
And I know you had a good outcome in the end. And Roy just did a question of sort of asking one of the things in the back of my mind, which is you put all this upfront work and you bet on this business early on through the minority investment or the minority, I guess, investment. And theoretically, the owner, well, it could have been a bad relationship, and you could have theoretically wasted that effort and time. But also, the owner could have you could have put all this effort in. They could have been sold the business to somebody else. So ultimately, that didn't happen. But how did you think about that?
They in fact got another LOI in the fall of 2019 that I had to battle against a little bit. So that was a factor. I will say I did get paid for my consulting, and it was 2 days a week, so 2 days out of 5 a week, and I got paid for it, I think, pretty well. And I learned a lot from it. So I didn't perceive it as a huge downside risk. And my thinking was always, hey, I have capacity in my calendar to invest in this opportunity. And if it goes somewhere, great. And if not, then at least I got some cash out of it. So
it's interesting. It's almost like a bond and an equity return, right? You got the bond return of your time in the consulting dollars, and then you've got the equity option, right, to invest in the future. Like I think that's a really smart way of doing it.
Yeah, no, I understand from the questions here that there is some curiosity about it. I now that I'm an independent sponsor and looking for my next platform deal, it's not a structure that I'm necessarily hopeful to replicate. It was a happy accident, I think, to some extent, that you positioned it as earlier.
Got it. Before we go on, you mentioned the point earlier that you really liked the B2C aspect of this HVAC business. And I know we had a question that someone had sent over email earlier about, can you talk to commercial versus residential? My take when I think of business services and what searchers go after is they really like the B2B component, because often the business is contractual and it's much less at risk of going away. How do you think about that sort of trade-off in commercial versus residential HVAC, and why did you decide to go the residential versus the commercial route?
Yeah, no, good questions. So definitely let me cover the residential versus commercial, but I don't necessarily think residential is higher risk because you're much higher volume and you have no customer contact.
And much lower customer density,
Yeah, so I don't think it's less or more risky. In fact, I can argue the other way around. And the fact that you don't have contract, yes, you rely on the phone ringing every day, but if you have a track record of it ringing, it'll continue to ring. It's just kind of how it goes. So with SEO and everything going on. So, but as far as residential versus commercial, I would say in the right before COVID, there was a definite trend among the financing sources I talked to prefer commercial. And it was the reasons you mentioned there. It seemed more stable, slightly higher profit margins and higher barriers of entry because you need a little bit more equipment and skill sets to do larger buildings.
Sure.
And then COVID happened and commercial, everyone commercial, or a lot of commercial office buildings and so forth went at least sour for a little while there. So like Q2, Q3 of 2020 were really bad in the parts of the commercial HVAC industry. Meanwhile, the residential market was taking off. So I think COVID changed the perspectives a little bit on it as far as the risk goes. I would say both are very competitive. And within commercial, you kind of divide between more serious stuff like hospitals, data centers, skyscrapers, big hotels, right? That's special stuff that you need special equipment. It's not for your everyday HVAC contractor. But light commercial, and we do about 10% of our revenue, is like, think about your strip mall or your Chick-fil-A or school or church, like stuff like that is light commercial, and anyone can do that because it's on the ground and you don't need special equipment for it. So there's some overlap there, but yeah, I would say they're pretty typically when you look at the companies, they are one or the other, and I think there is merit to being commercial, but I just prefer the residential side. Another question you had from that email, Tony, is how to think about new construction versus service.
Yep.
So let me just elaborate a little bit on how you quickly define them. New construction is anything where you work for a builder, and service is anything where you work for a homeowner, at least in the residential space, right? So those are two different customers altogether. Builders are repeat customers, but it's a low margin business and it's cyclical. And the cyclicality is what private equity shops really, really don't like. So you should get a much lower valuation on construction businesses. Now, service, this is where you see the crazy multiples right now. It's not cyclical, but it's seasonal. And that creates other challenges, but they're more stable from year to year. So private
and I
equity,
imagine that seasonality is controlled depending on the market you're in. So to your point, in Texas, where you've got this needs all year round, I assume there's less seasonality, right?
yes, that is correct. Although we definitely have seasons here as well. But I will also say cyclicality depends on market. You know, if you're in a low growth state right now versus
Totally.
Texas, the outlook is bad. We do have some new construction exposure with our company, and the spin I gave on that is, you know, you got to look at the macro for Texas. You know, we're going to increase the population in DFW by 50% over the next 20 years. The outlook is good. It might ebb and flow with the economy, but we know it's going upwards. So as long as we have a balance sheet to weather any ebbs and flows, it's a good market to be in. So I don't think new construction is meritless. Also, for us specifically, it provides two value points. One is, since it's not seasonal, we're able to utilize our team 40 hours a week throughout the year, which enables us to retain employees, but also actually to be pretty competitive in the price per hour, because we can promise number of hours as opposed to having to pay them more per hour during a shorter time period. And then it's a huge lead generator. You know, put your sticker on a unit that you installed, that turns into a service customer down the line.
And so it sounds like the ideal setup would be a business, and it's maybe a segue into the next slide, but high service revenue in general, with a component of sort of new construction revenue, because it's a lead gen source, because it keeps the teams more evenly providing work in the slower months. That's probably maybe less of a need in markets that are further south, that are more and less seasonal. So maybe Southern California, Texas, the South, but certainly it would be that need to be even more true as you move further north. Fair?
Yeah, I wouldn't go so far as say new construction is preferred as part of your revenue mix, but I'm just saying it's not all bad. And another big point about new construction is it gives us the scale that I talked about on the procurement. So, but yeah, if you're in the right market, it shouldn't scare you away too much if you can manage it correctly. That was the point.
That's cool. Well, let's talk. I mean, we're talking about sort of the revenue mix of service versus non. I think it's a great segue to your good versus great structure. What I'll just let you drive this. I want to walk through how you thought about good versus great.
Yeah, it was a little bit of a tricky slide here, because if it was bad versus good, would be easier to contrast. But you're
exactly, because good, I assume you interpret this, you would still consider buying a company in the good category. It's just you would ideally want to buy great, right?
Yeah, I think that's right. So yeah, let me start at the top. I think EBITDA, you see a lot of smaller HVAC companies. I think they're really nice as add-ons. Right now, we're in talks with a company that has about 2 million of revenue, which for us makes sense because we can get 25% margins out of it. But for a financial buyer, that will be harder.
And specifically, it's because of what you referred to earlier, because the margins are going to be compressed because you can't buy at scale and get the efficiencies at scale. Like that's the prime issue, right?
But also on the HR side and the system side, you just need to have a critical mass of investments into the back
before you can invest in that.
So, so smaller companies, they're fine. And a friend of mine bought a $500,000 EBITDA HVAC company last year, and he's doing great. So it's not that it's impossible, but I like to say a proper scale starts around 2 million of EBITDA if you want procurement and marketing and like be a serious player.
And I guess before, just roughly, this question came in around how do you think about the size of the team or rough framework for good versus great on EBITDA per employee at the 2 million mark, let's say?
Sure, good question there. We have about $100,000 of revenue per employee per quarter, if I remember correctly.
That's revenue, not EBITDA.
That's revenue, and then our EBITDA is, you kind of saw it on the previous slide, it's like 10 to 15%. We're working to improve that, but and as far as your team composition, somebody said to me it should be like 80-20 with field workers versus office workers. I think that's a little aggressive. We're more in the 1/3, 2/3, but we're working to move that up towards 70-30 at least.
Got it. Ideally, or the point being that you want to create the overhead as low as possible, like have it there so you can support the team, but ultimately want to minimize the sort of back office as much as possible relative to the field, right?
Yes.
Cool.
Yeah, so going back to the slide, so EBITDA, it all works. If they're profitable, they're profitable, so it's fine. But if you want to scale to have a differentiator in the competitive market, then I think you need to have a certain scale. Revenue mix, I mean, the more service, the better. And service and captures everything that goes to homeowners. So, the emergency service call, the maintenance, which we compare to changing oil in your car twice a year. You should also check your AC system twice a year. That's at least what we like to say. Routine tune-ups and checkups. And then, of course, any repair and replacements that you will need. And replacement is the big profit driver for all the companies in our industries. But all the other components there, they kind of lead you to replacements that you're there when they need that, right? But the more you have of homeowner service, the better it is for your valuation.
Sure. And the replacement, like an actual unit revenue, is that included in the service revenue? I assume that's not.
Oh, can you repeat the question?
When you say there's replacement, like that's obviously there's both a service component to replacing the unit, but then there's just the unit itself that you are replacing, and you're taking probably a significant margin on that unit. Is that unit that you are replacing, is that considered service revenue, or is that a different line item?
Yes, correct. Okay. Some people mix renovation and replacement. Renovation is when you work for a builder, right? Replacement is when a homeowner has called you and said, hey, our system stopped working, you need to come and replace it. So, and I saw a question here from, I think it was Roy, what are the margins? Bottom line margins on, if you're a pure new construction business in HVAC and you're doing pretty well, you'll be somewhere between 6 to 9% bottom line. If you're a really good player and service pure play, you can be at 20 and maybe even a little bit above 20%. And this goes also to the gross profit for service, and this includes replacement. Your gross profit can be 40% plus. For new construction, your gross profit is going to struggle to be above 15%.
Because of the nature of the big builders having so much control over pricing.
Yeah, it's just a high volume business that you do with repeat customers. So it's a different business model. It's more of a product sale than a service, if that makes sense.
Yep.
The next thing here, so when you talk to bankers, they will say there are 3 components that matter for valuation. It's EBITDA, revenue mix, and Google reviews in that order. I kind of agree with that. And Google reviews, I mean, think about it how you think about it when you're a customer. If you're impressed with it, then it's probably good. And if it's like, hey, it's 4.1 and they only have a few reviews, what's going on here,
Do you find, I mean, when someone's considering selling their business, are they proactively trying to do this in advance, like the smart owner, you think, or is no one thinking that far ahead?
I think the sophisticated players will focus on it, but not because of selling, but because it helps them.
It's good for the business.
Yeah. But yeah, reviews definitely matter in this industry. I think, and this is my thesis, I think barriers of entry to HVAC service are finally increasing. I think for the last 100 years, it's been really easy to enter this market. You could be Billy Bob down the street, you could splash a newspaper ad and a billboard, and that would be your marketing and your phone would start ringing.
Yeah.
Today, all traffic goes through Google, and the big players just have so much more traction with the reviews, with the SEO, and with the ad spend that they can afford, that I think it's harder to be a new entrant today. It's just going to be harder to get that phone ringing in the beginning. And every month, the chasm between you and the big players is going to increase because they invest more in blog posts, they invest more in getting reviews. And that's why people always talk about how this industry is consolidating. I think they've been saying this in HVAC for 25 years. I actually believe it might be happening right now. And the reason is Google, and Google, who tries to democratize business, I think they're actually doing the opposite in our industry.
What I could riff on this. When I'm hearing you just sort of describe the trends in customer acquisition, sort of begs the question for me of what are the top channels that you think in a searcher, once they acquire the business, should be leaning in, right? You're on the one hand, you could build out a digital marketing team who's really effective at Google or Facebook, whatever. You could send physical mailers out. You could be doing the more organic SEO or reviews? Like, how do you guys think about prioritizing any of that customer acquisition if you had to boil it down to 1 or 2 or 3 channels?
Yeah, I think there are no hidden ways, like no low-hanging fruits as far as marketing goes in the major markets now for HVAC companies. All of the methods there's already someone trying it. So you got to invest in the most effective channels, and it's hard to get around Google and digital advertising as the most important driver. That said, one of the companies we're talking to right now, they don't do any Google AdWords or SEO at all. They're just hyper focused on like 3 zip codes. They have billboards. They do direct mail several times a year, and they are growing very nicely with that strategy. And then their vehicles, of course, are driving billboards essentially, right? Driving around those 3 zip codes all day long, every day. So that company is having good focus, but they're small, and so this is where on the bottom of this slide, actually, I think they're great because they can pinpoint we're growing because we're extremely focused on our geography. And that seems to be a marketing technique that's working for them. But otherwise, if you're trying to cover all of DFW, then you're going to have to invest in Google and so forth. And sources say, some say you can invest as much as 8% of your revenue in marketing.
8% of marketing revenue, 8% of revenue in marketing, and you're saying is a good benchmark?
For service companies, some people think it's that high, yes.
Okay. What kind of riffing on your point you just made about, if someone knows the lever, knows the channel that's driving growth in the business, like that's what you care about. You don't necessarily care if some of the other channels are not performing, right? If they're, as you said, they don't have any or a very limited digital presence, like that wouldn't be a turnoff per se, as long as they can say, oh, but we are driving growth in this area. And it does that, like I see a lot of searchers that say, oh, because there's been such a lack of investment in digital acquisition, that we're going to be able to enter and do that, and we're going to drive even faster growth. And on the one hand, maybe I can believe it, but on the other hand, given what you just shared a second ago, that it's so competitive and the big guys have such a big advantage, how realistic do you think it is for an acquirer to implement a digital marketing strategy if one doesn't already exist?
So my thinking on the HVAC market is it's really hard to be number 1, but it's not that hard to be top 10%. And if you're top 10%, you're going to be gaining market share. And I think if you have a sophisticated approach to marketing, you're going to get into that top 10% if you're in a major market.
Okay, I like that. I like it. So you don't have to feel like you're number 1 or number 2, but you can be.
It's not a winner takes all market.
Yeah, that makes sense. By the way, this is a total aside, but as we're talking about customer acquisition, you made the point earlier that, I guess we both made the point that the bottleneck to growth in this industry and many business services is having a pool of quality technicians and being able to recruit and retain them. Is there, when I think about assessing a software business or, a white collar business and how good they are at retaining talent, I look at things like Glassdoor and I assess how are the employees feeling about, the reviews they're giving to their bosses. What's the analogous system or method you would use to assess how happy or how the employees are in the business, the staff, and how likely you're going to be to retain them? Your thoughts around that? I know this is kind of out of the
it's a really good question. I'm thinking about it as like a prior to closing, how can you vet the employee pool? And I don't know if there's a good way to do it. You can ask for I always ask for the org chart, and then I always ask who are the key people. I always get, how many years have each person been with the company and the org chart, and that gives you a sense, of course, but
sure.
Can you truly believe they're going to stay there forever, or lifers or not? I mean, you never know. There is some churn in this industry. It's just inevitable because when you're in March and April, competitors get really aggressive about we need a technician now, So it's inevitable. But what's more important is that you have a good source of recruiting. And we've tried these like vocational schools, we've tried training schools. We've tried hiring novices that have no experience and kind of training them over 6 months as a helper. To get a really like top class technician who is performing from day one, it has to be word of mouth, typically from our technicians who know someone who's doing it for another company.
Do you incent your techs for like a referral fee where they bring somebody else in?
Yes, they get a little bit for that.
And anything else beyond that that you would say is particularly effective, either at recruiting or retaining those technicians that you have in place today?
For us, we play up the we can guarantee you 40 hours all year round. That's a big one that we use in our case. But money matters, of course, as well. So if you can showcase, we have technicians who are making well into the 6 digits, and you can become one of them, that's obviously something they'll listen to.
Is it the case that
management
techs are always paid? Sorry, I don't mean to speak over you. Go ahead, Niklas.
No, I was just saying also the management team is super important because they need to, they're the head of sales, so to speak. So they're the one they report to every day, and they need to be inspired by the management team.
Do you, I guess relatedly, is it when you were describing a second ago that you can guarantee the hours and B, some of them are doing really well. I guess I was under the impression that the techs would be paid like a flat hourly rate, and it wouldn't be sort of this piecemeal type thing. But it sounds like they are making, if not commission, something that's commission-like on how many deals or how many transactions they're doing. Do you find that? I mean, do different companies actually price this differently, where there's an advantage to being sort of a flat pay structure versus a per installation or per service call solution?
There are different personalities among the techs. So, the one that's coming to your home when you're calling for emergency repair is going to be a really good tech who is able to drive revenue from that call. Now, if you're what we call a cool club member that we have twice a year, they come out and change, they just change the filter and so forth. Those are kind of the level below, and then warranty techs are the level below. And below, I don't mean technical capabilities. I more mean an appetite for customer interaction and hunger for that sale. And the technicians themselves kind of decide which pool they fit best in, and we compensate them accordingly. That their mix of commission versus hourly is a little bit different based on which bucket they're in. And then we try to graduate some of them up to the service tech if they're performing really well with the maintenances, and back and forth. But it's a dynamic thing.
That makes sense. Speaking of team, by the way, I don't fully follow this transitory versus a long-term solution on team. Can you riff on that a bit?
Sure. A lot of business owners will say, I'll stay around for 1 year after the sale. That's a transitory solution. What are you going to do after that? You need to solve for it, right? Versus in our case, we had founders who are invested for the long term. They're also at the age where they're going to stay forever. So that's great, right? Right now, we're doing one add-on that the owner is retiring, and we need to find a solution to put in place there. We think we have a good solution, but of course, there are risks around employee retention in particular when you do that. So that's why I would put that particular criteria in the good bucket, not great.
What do you think? I mean, I think the bulk of searchers who are looking to do deals are they're not doing the independent sponsor where they're keeping the management team in place. They're doing a self-funded search and buying out the owner, and their owner is leaving. So in that world, and it sounds like you're doing this with this new deal, what do you think? What are those 1 or 2 best practices that you're trying to put in place to ensure there's a healthy transition?
Sure. As an independent sponsor, I'm looking at one deal right now where I'm telling the owner stay around for 3 months full time, and then I'm giving him the option to roll some equity, and I'm offering him a board seat. And I think between those 3, it's a good way to keep some continuity. And also, when you spend a narrative to the employees post-transaction, you can say the owner is still involved. He's just kind of stepping out of day to day.
Yeah, that makes sense. I think we covered everything on this slide, and I know we've got a few others. So let's hop through. Given that time, and we've got roughly 10 minutes, we just do a higher level overview or dig into any area you think is particular on the diligence, things you paid attention to, and then we can talk about some of the major risks or issues in the industry.
Sure. I think most of these probably talk to themselves, like labor shortage and fleet quality.
Yep.
Fleet quality, yep. I mean the age of the fleet, right? You need to suddenly buy a lot of vehicles. For vehicles, you should be having a fixed capex every year. Unless you're growing really fast, it'll be growing, right? One thing I would look at when you're evaluating a company is, did they have any large commercial jobs, like $400,000 revenue jobs that really affected their EBITDA and financials in the number that you're basing your offer on? As far as
And just to unpack that, is that a customer concentration comment, or what like
no, it's
specifically?
just like you can get one, let's say you get a school, and that's one commercial project that they do. They're mostly a residential company, but every now and then they get a commercial project, and then they have a $400,000 spike in their revenue last
Yeah.
year, and they don't tell you why, but it could be actually just one project that did it, right? So beware of that. OpEx, when we look at add-on acquisitions, like it's this is where we're always looking, where can we save, where can we shave, and this is but the danger I see more on the ones that you see on Biz Buy Sell is that they're actually presented as too lean. They have a broker who knows, can we squeeze the OpEx? They tell the owner for a year, just squeeze OpEx in this base year so that when we sell this in February, it looks like your EBITDA is inflated. And a lot of the companies I look at that are like less than 5 million of revenue that I find through brokers are very lean on the OpEx, and they've been deliberately put in that position.
Can you speak to like what's too lean?
Just means they don't have the staff, or they're not investing as much in marketing in that particular year, or I can't
I guess
pinpoint
as a percent of revenue, maybe.
Yeah, as a percent of revenue. I mean, the fact is, if you want to grow, it has to be a balance, but you do need to invest in OpEx as well. And if you see a company, like I saw companies for a broker the other day with 3.5 million of revenue, 1 million of EBITDA in a very competitive market, and that's really hard to accomplish. I didn't really vet it more than that, but I'd be curious to look at the financials of that particular company. CapEx concerns, there shouldn't be a lot of CapEx. The only thing would be vehicles.
Yeah, I would, beyond vehicles, there's no really specialized tools there are, but I guess that's a minor expense relative to the actual,
sure, relatively speaking, yes.
Yeah, okay. And pitfalls, and we've kind of talked about a lot of this sort of pitfalls and what's hard about this, but I'm trying to think if there's anything that we didn't cover so far. We didn't cover the networking capital, so maybe dig into that a little bit. Or I also actually, there was a question earlier about sort of good versus great EBITDA multiples and valuations. Everyone talks a lot about how this industry is overly inflated right now in terms of valuations. Yeah, what do you think is actual market right now?
No, I talked to one banker the other day. They wanted the 9x on a 1 million EBITDA company. It should be half of that, is my opinion. Yeah. I do think when you get to critical size, 3, 4, 5 million, or better yet, 7, 8, 9 million of EBITDA, then you're kind of talking better EBITDA multiples. But for small businesses, I think what you learned already about searching, the 3.5 to 6 range, that's where all of these should be. And for HVAC, they're not high growth subscription revenue type models, right? They shouldn't be 6x. The only reason would be if you get it and you can flip it to a strategic the day after, right? Because they are in fact paying high multiples. Sure. But the valuations are high, not because the businesses are worth it, but because there are strategics who can extract that kind of value. So as a financial buyer, be aware of that.
So just to press on that point, for a great company, based on the metric you talked about before, up to, let's say, a couple million in EBITDA, the 6x EBITDA would be sort of the max you'd be willing to pay, with the exception, of course, of the strategic point you just made earlier. What about a larger company? Would you be willing to pay a little bit more because the strategic maybe is more likely to come in, or what would be your cap at, like, say, a 5 million EBITDA HVAC?
I'm distorted at this point because I've been thinking about everything as a strategic for a while, but as a financial buyer, for a $5 million EBITDA company, you could go pretty high. I mean, 6, 7x would be okay. I wouldn't go like 9 or 10x, but 6, 7x, yeah. For a $3 million company, I would sniff at 6x. For a 1 million EBITDA company, I would not go over 5. It's just a lot of debt to service and people to pay back with a cash flow that's not going to grow, that fast.
And your point about the strategic versus financial buyer, just to sort of drill into that for a second, what the strategic is hoping to achieve primarily is just greater operating margins, because ultimately they're able to acquire at much cheaper rates from the actual manufacturers. Like, that's the main driver. It's not necessarily that they're hoping to drive greater or I guess maybe the secondary lever would be greater customer acquisition through greater marketing or whatever else. You think that's the right order?
Maybe there are other parts to scale other than procurement, but also I saw Dubin Clark, big private equity firm in Boston. They just exited. There was an email announcement this morning. They exited their HVAC platform after only 2 years. I believe I remember they did 2 acquisitions earlier this year. So I can imagine they did those 2 acquisitions in February. They probably paid a lot for those because they knew they were going to flip it 3 months later. And the exit multiple they can get when they have, I don't know what they have, but 8 million or 15 million in EBITDA, it's a pure arbitrage opportunity for them. And that's where the strategic players are working right now.
Yeah.
Let me quickly cover the net working capital.
Yeah.
Normally, business owners understand this. In HVAC, I found they are pretty stuck up about the AR is money I've earned. Why should you have that? And it's really hard to explain to them that it's an operating asset that we need to operate the business as is. So keep it simple and clean as far as net working capital goes.
Makes sense. By the way, when you say unsustainable revenue mix, is that the point about service versus new construction, or is there something more nuanced there?
I think I was more talking about the commercial projects that are more like one-off.
Oh, the lumpiness, yeah. Okay. And on the hardest other column here on the right,
I quite enjoyed how generic I made that part of the slide.
Yeah, exactly. I was trying to figure out a polite way to say that, but yeah, it feels like this is true of most businesses. Anything unique here, you think?
No, I think we've covered it. Growth is hard just because you need to invest upfront. Profitability is hard. You always get squeezed. It's competitive. Marketing. I think this is where you need to differentiate. It's possible, but there are no low-hanging fruits. Labor shortage happens everywhere right now, and procurement is it's just a fact of life unless you have scale.
Yeah. 2 people independently asked a question in the chat here around licensing and if that licenses can be transferred when you buy a business and whatnot. Like I imagine some of that's state specific, but what's been your experience and how difficult is it? What do you need to do to actually from a regulatory or license perspective?
You need 1 licensed HVAC technicians to have 1 location in Texas.
And that's transferable when you buy a business or whatnot. That was not an issue.
I don't think you need to qualify for it. I don't know how to qualify. We kept the founders around.
Oh, right. You didn't have to do it.
And this is not a thing every technician has. It's typically just the owners who have it. I don't know. I honestly don't know much about this.
Okay. Biggest lessons, and then we'll sort of wrap up. I know we're going to go a couple minutes over, but yeah, we'd love to maybe end here and then how people can reach you.
Yes. Yeah, just very generically again, I think 20% of our technicians drive a lot of our revenue. It's not that the others aren't valuable and also carrying the load, and we need them as well, but the profitability comes from the high performers.
And they're high performing in that they are just more available. Like what makes them high performing in terms of driving revenue?
Customer connection. They're just able to go into every house and get more dollars out of every call they go on.
Oh, interesting. So that's like they're just better.
But they also get better reviews. You would think, oh, they probably get the worst reviews because they're so pushy, but they get the best reviews because they're so good at educating the customers and saying, here are your 3 options. I would recommend going this way, but you don't have to. But they're just very good at that.
Interesting. Okay.
Yeah, and the rest of the slide is self-explanatory, I think. But this is a product service. There's definitely a need. I mean, the market is there; it's not going away. But it's competitive, and you need to be on top of your game with your operations and your sales and marketing and everything in order to maintain revenue. Cool.
Going back to I hesitated to ask, but I got it now just because I'm thinking about it. The employees that are driving this 80% of the value. Are they directly incentivized by what business they're bringing in? Like, is it commission based?
We have comfort specialists that are salespeople, and they are only commission based. Technicians will have a component, a mix between salary and commission.
Yeah, that makes sense. I mean, it just feels like that begs that component, right? Like, if this is true, you would certainly want to incentivize.
Yeah, exactly. So let me. I mean, the example is a technician goes in the field and he's been asked, "Hey, my AC is malfunctioning." That's not clearly a replacement opportunity, but that's their opportunity to upsell, but they already get a base. Sometimes we get calls, every day we get calls, hey, my AC is broken, I need a new one, can you come out? And that's where we send the commission-only comfort specialists.
And they're driving something, I got it.
Yes.
Cool, man. Well, I have this one takeaway, and maybe as we're just sort of pulling this slide up around how people to reach you. What is that one takeaway you think if people are thinking about buying a business, if there is one in this industry, and then how can they best reach you?
You can best reach me with the information right there on the slide. Please add me on LinkedIn, and if you ever see opportunities in the HVAC space that I can help with, or maybe even partner with, I would love to hear from you. As far as my one takeaway from working in the HVAC industry, I just like the stability of it. This is an industry that is not going away. I like that it's predictable, and I can see kind of where we are going to be in 2 years and 5 years, and that excites me.
That's cool. I mean, it's so it's awesome to sort of hear, but over just a relatively short amount of time, for a couple of years, how insightful you are on this industry at this point, and how in the weeds you are, and how you're building out this platform. So, again, thanks for sharing your insight and detailed feedback here. There were other questions that came through from others in the chat that we didn't have a chance to get to. So, I mean, you guys can see here how to reach Niklas. I'm sure he'd welcome questions and follow up. And again, I guess, and just to wrap, Niklas, I've been super pleased and impressed with how open and helpful you've been, frankly, with me and thinking of my own investing. So I can certainly vouch for Niklas as someone who could be a real value add and an asset to any searcher. So thank you, Niklas. Thanks to everybody for attending and listening in. And of course, if you like this webinar, I'll be sharing a recording, and just shoot an email to webinars@bluemaple.co. if you want to join ones in the future. Thanks again, guys.
Thanks,
Niklas. See ya.